So imagine the growing death benefit, the cash value has to rise to chase that death benefit. The promise from the life insurance company is expanding the death benefit, and the cash value and death benefit have to match by age 100. But the window of time, us aging every day closer to age 100, the window of time is shrinking. So the promise is expanding, but the window of time is shrinking. So there's forced efficiency. The cash value that accumulates day after day and year after year, it can only increase to stay on track with the schedule. It has to accelerate and become more and more efficient over time. Your money, your wealth has to reside somewhere. It has to be deposited. Now, what we're going to do is do a bit of a thought experiment. Think about this for a moment. We're here to learn how to enhance our investment returns. You get to actually invent a brand new asset from scratch. Now, the only thing is that this asset that you're creating can have no drawbacks. What would be the perfect investment if you could create one? Let me share with you some of the most popular answers that we've gotten. High rate of return, consistent rate of return. It's conservative, so it's safe. So we have liquid, guaranteed, tax benefits, no market volatility, yields income besides capital gains. We have creditor protection, that's a good one. Inflation protection, control, transferable, easy to manage. This is really a really good list. No hidden fees or penalties, reliable, or excuse me, reputable. Private's pretty important these days, I would say. The question is, for your own various assets, I want you to look at this list and ask yourself, which items out of this list do your various assets do well on, and which features do they fail to satisfy? Now, I also have a surprise for you. The list of attributes that we just showed most accurately describes a participating dividend-paying whole life policy. Now, if we're going to implement the process of becoming your own banker, the infinite banking concept in Canada, we have both a process and a tool. We have a tool that we need to use to implement the process. And this is the best tool we've been able to find for the job. So let's examine the tool for a moment. It is participating. What does the word participating actually mean? It means that you become a co-owner in the mutual life insurance company, and you participate in the profits generated from every line of business. Life insurance companies are selling term life, universal life, whole life, critical illness, disability, group benefits. The list goes on, and we get the benefit from all those product lines. It's dividend paying. Each year, the life insurance company declares a dividend. It is contractually guaranteed to be paid to the participating policy owner, and it can never be repossessed, and it can never lose value. It's guaranteed by the life insurance company. Whole life, what does that mean? Now, there's nothing wrong with term life insurance. I have a bunch of term life insurance myself, but it is a good solution for a term. You are the life insured for your whole life until age 100. So you're covered for your entire lifetime. And this is one of the most important contractual guarantees in my mind. There's cash value that accumulates in the policy right from day one. The total cash value in the policy must equal the total death benefit by the time the life insured reaches age 100. Now, it has to rise on a schedule. Every single day that you age, the total cash value rises and the policy cannot lose value. So as I said earlier, every single day that my family and I age, because we're all insured in the system, there's more capital available for us to use than there was the day before. We don't have many financial guarantees anymore. Pensions are going by the wayside. There's doubt about the future. Dividend paying life insurance company or life insurance can help create peace of mind and unmatched financial security. And here's how. Cash value begins to accumulate immediately, and it is contractually guaranteed to grow daily. Cash value cannot go down. It's easy to access, and you have control over a growing pool of financial value that you can use to take advantage of opportunities that will track you down. You're not penalized for accessing the money early like you are with an RSP or other financial products. There are several tax advantages, both personally and corporately, and it provides a growing death benefit, which will obviously be paid out to the named beneficiaries on a tax-free basis if the unthinkable happens and you were to pass away. So imagine the growing death benefit The cash value has to rise to chase that death benefit. The promise from the life insurance company is expanding the death benefit, and the cash value and death benefit have to match by age 100. But the window of time, us aging every day closer to age 100, the window of time is shrinking. So the promise is expanding, but the window of time is shrinking. So there's forced efficiency. The cash value that accumulates day after day and year after year, it can only increase to stay on track with the schedule. It has to accelerate and become more and more efficient over time. Remember that there are deposits going into the bank, but in this case, we are depositing money into the dividend paying participating whole life policy, our private banking system, because you are your greatest advantage. You're earning income, you're depositing money, and you can become a wealth creator by implementing the process of becoming your own banker. Now, this is our sort of our zero line, and this green line here represents the cash value that's accumulating inside the policy and growing each and every day. This line would represent time. So we have age 100 out here, and it doesn't matter to me, but I'm just giving you an example. Let's imagine that we have a death benefit of $100,000 to start, or maybe it's $1 million. It doesn't really matter. Now, what's happening, as we know over time, is this death benefit is rising. And here's our age 100 again. So we have age 100, age 100. Death benefit is actually, death benefit's rising. Okay, as time goes on, as we capitalize the policy and as we receive dividends, and the cash value has to grow and accelerate so that it matches the total death benefit by age 100. As the cash value is rising, you can see here that the difference between, the zero line and this green line represents what we call a policy loan availability. We can actually access the money. Now, this is just a visual. Don't let this distract you. We're not actually going below the line, but we can access up to 90% of the total cash value anytime we ask for it to take advantage of opportunities, whether that's financing your next rental property, whether that's buying out or recapturing the debt on car financing, whether that's paying for your child's education. You can go ahead and access the policy value, but this red line is coming down. And then these stepping up, these lines represent that we're actually making loan repayments back to our own system. Because if we're going to borrow money from a commercial bank, we're going to make payments to the commercial bank. If we're going to borrow money from our own private banking system, we're going to make payments back to our own system as well. So now, as we're making these payments back to the system, you can see that the green line is continuing to rise, and we always have access to a growing pool of financial value. We have access to the difference between whatever our loan balance is and that daily cash accumulation. So if our loan balance is going down and our cash value is rising, we always have access to the sandwich in the middle of the cash value. You can see that it's a growing and widening pool that we have access to take advantage of more opportunities. We're actually creating true momentum on our money. We can access the capital without interrupting the compounded growth on the money. So compounding is great, but what's really powerful is uninterrupted compounding. Now we're going to dive into creating our own banking system and examine Nelson's rules of how we want to go about doing this. Get out of the instant gratification. We need to think long range. We need to think 2 or 3 generations ahead. Nelson was trained as a forester, and that's what he learned early on, to think 75 years into the future. So I've got policies on my children already. My daughter's 12 and my son's 14, because if and when they have children, I'm going to then expand the system and put policies on those grandchildren to continue to expand the system into the future. So we have to think long range. Don't be afraid to capitalize. Your wealth has to reside somewhere. And isn't it true that right now, all of the money that you're earning is flowing to someone else's bank anyway? We're actually capitalizing someone else's business. So don't be afraid to capitalize your own bank. Don't steal the peas, as I mentioned earlier, and same with that wealth creator slide. If I'm going to access a policy loan, I'm going to pay back what I used, and I'm going to pay back more than what I used, because I'm just putting more energy into the company that I co-own so they can become more profitable, and I have more access to capital to accomplish more objectives. Don't do business with banks. When we do business with banks, a lot of cases in Canada, people are unknowingly and unwillingly contributing to the inflation problem, because the banks are expanding the money supply by issuing loans, but the life insurance companies are not allowed. They are not able to expand the money supply. So don't do business with banks. And the 5th golden rule that Nelson added toward the end of life he added this other rule, and he said, rethink your thinking. Not only do we have to think about the process, but we need to rethink our thinking so that we can take advantage of new ways of growing wealth and new opportunities. As I mentioned earlier, when you can think a new way about something, you can create new opportunities. Now, what I'm going to do is I'm actually going to share a testimonial from one of Jason's clients, and I'm going to because he does an excellent job of framing up his progress and what he's been able to achieve by implementing the family banking concept. So he says, after 2 years after opening our first policy, we took out our first policy loan and paid off the bank loan on my wife's Subaru. Now, the important part that he says, redirecting the payments from the commercial bank to our own family bank. So they were already paying for the Subaru and they had a payment schedule already going. They just didn't change their cash flow. They just redirected the money back to their system, so they have use and control over that money. 3 years later, 5 years into the journey, we took out another policy and took out another policy loan and skipped the bank entirely this time, using the money to buy a brand new SUV outright. And then they would have created their own repayment schedule to replenish that pool. In year 5, we also had another child and took a policy out on him, as well as a second policy on myself. So they're expanding their banking system, right? Money grows on branches. So we need to expand and create more branches. With 5 policies now in force, after 7 years, our mortgage was coming up for renewal. Real estate investors, instead of renewing with the bank, we took out a policy loan from each of our 5 policies, because you're the owner of the system, you can do what you want, and we paid off the mortgage entirely. So he was able to accelerate his mortgage pay down, and he had a schedule. So what he was able to do is pay off that mortgage and redirect those payments, recapture those mortgage payments from the family back into the family system, so that they could use and control that money. And then they had a property that was owned outright. And I know your creative brain is thinking already, what can you do with a property when you have no mortgage balance on it, when you own it outright? You could obviously, if you chose to, you could register a line of credit against that home and go in and purchase more rental properties and expand your portfolio even further and create more cash flow.